Part 2, Chapter 3. Now we're going to walk through the preparation of a balance sheet. We're going to look at an example and walk through, help you with your homework. Now, current asset valuation, listed based on expected conversion to cash, sale, or consumption, either in 1 year or the operating cycle, whichever is longer. Valuation based on cash and cash equivalents or fair value, but usually it's their face since they're very short term. Short-term investments, fair value, amortized cost. Receivables, net realizable value, that's accounts receivable, less allowance for uncollectibles. Inventory, lower of cost or market, we go over that later on. Prepaid expenses are at cost. So now we're going to look at a balance sheet and we're going to check them all off as we use them, because whenever you look at, again, this would have been a adjusted trial balance, you want to make sure that you have checked off everything that you see, because otherwise in the end you won't balance. Now here's an example, but in this case the retained earnings, we've already rolled up the net income less dividends. So that is the only time you're going to use that retained earnings, unless they tell you that in the problem, when you do your balance sheet. So now what we're going to do is prepare our balance sheet, and we're going to start with current assets, and what we're going to do is check them. This is what I do. This is the process I go through. I check them as I go because I know I'm only going to use them once, but I have to use all of them. So in this case, we start with our cash, then our accounts receivable, then our allowance for doubtfuls, which is a contra account, which means the balance is the opposite of the account that it follows, which is accounts receivable. So accounts receivables normal balance is a debit, allowance for doubtfuls is a credit. Inventory. The portion of marketable securities that will be sold in the next year. So this is an example of our current assets, and that would have been our calculation. So we know that 60,000 would be under current, and we have to make sure we remember that the other 60 would be non-current. And also our prepaid expenses, we have to include that too. Now we're going to take a look at what does that look like on our balance sheet. This is a classified balance sheet. So we're going to start with our current assets, then we're going to do our marketable securities, the portion that is current. Then, that's how we calculated that previously. Then our accounts receivable, we're going to show net, and that would have been our gross accounts receivable of $357 minus our allowance account of $17. We would show the rest, and now we have our total current assets. Now we're going to move on to the non-current or long-term, and these have a number of sections. So, non-current assets, their conversion to cash for greater than a year or the operating cycle, whichever is longer. Examples would be securities, bonds, common stock, or long-term notes of other companies. Tangible fixed assets not currently used in operations, land held for future use. These what we would consider investments under the category called investments. Special funds, sinking funds, pension funds, plans expansion, or cash surrender value of life insurance. And the last would be non-consolidated subsidiary or affiliated companies. You learn about these when you take advanced accounting. So now let's go back and look at our example. So remember, when we're talking about this section of the balance sheet, these are assets that are not used directly in the operation of the business. So we would go through and we would find our other half of our marketable securities, and 50,000 in land of the 175 that's being held for as an investment. We're not using it. So now we're going to look at this presentation on our balance sheet. So we would have investments, we'd have marketable securities, and we would have our $50,000, which we are not using right now because our goal was to sell it, and that would give us our total investments. Next, we're going to look at PP&E, or property, plant, and equipment. These are tangible assets that we use in the business. Okay? They're long-lived, greater than 1 year, and we would depreciate these, except for the land. So we're going to check these off. We would have our building. We would have our equipment. We would have our accumulated depreciation. And we'd have the balance, or the 125 of the land that is being used by the business, which is the difference between the 175 minus the 50 that we've already shown as part of investment. Now we're going to look at this on our classified balance sheet. So we would show the land. Again, we're showing 50,000 of that land as an investment. And our equipment less accumulated depreciation, and that would give us our total PP&E. Now we're going to look at intangible assets. Intangible assets generally represent exclusive rights, can be purchased or developed internally, and we have goodwill, which is the difference between the fair market value of what you bought and what you paid for it. If it's greater, if you pay more than the net fair market value of what you receive, you generate goodwill. And this is particularly true if you buy another company. And we talk about that again in advanced accounting. And we have our patents. Now, the thing to know about patents, they're always show net of amortization. We amortize patents, and we always take it directly against the patent account. There is no accumulated amortization. It reduces the value of the patent that's shown on the books. Now we can do the rest of our asset portion of our balance sheet. So our goodwill, our patent, and now we know that our liabilities and equity must equal $2,178,000. Now we're going to look at our current liabilities. These are expected to be satisfied with 1 year of the operating cycle, whichever is longer. So we've got accounts payable. We've got $50,000 of this $125,000 note that's due this year. We have some deferred revenue. We have interest payable. Sorry, let me go back there. So those would be the items that would be our current liabilities. Now let's look at that on the balance sheet. And that gives a total current liabilities. Now we're going to look at our non-current liabilities. So these are long-term liabilities, are obligations that are due to be settled or have a contractual right by the borrowing company to be settled in more than 1 year or the operating cycle, whichever is longer, after the balance sheet date. We have to include the non-current portion of the notes payable, which is $75,000. So now we're going to check these off. We've got the $75,000 there. We've got premium on bond, which is an adjunct account. We've got the bonds payable. Now we can prepare the non-current or long-term portion of our balance sheet. We're going to show the bonds payable plus the premium. Now, a premium on bond, again, is an adjunct account because its normal balance is the same as the account that it follows. In this example, both have a credit balance. Now, if there had been a discount, we would be subtracting it, and the discount on bond would be a contra account because it follows it, but the balance is the opposite of the account that it follows. And we're going to include that $75,000. We have taken out 50 and put it as current, and now we have our total liabilities. Now the owner's equity section. We have capital stock, we have additional paid-in capital, we have retained earnings, we have accumulated other comprehensive income. These include all the amounts that bypass the income statement. And we have our contra account of treasury stock, which is contra to equity, which is when the company goes out and repurchases their own stock. And the last thing we have is non-controlling interest. It's the equity value of other companies' stock where consolidated is required but not wholly owned. Example, here, which kind of shows you what it's about. A company owns 80% of another company's stock. The 20% not owned would be shown here as part of non-controlling interest. So, again, when we talk about equity, we've got paid-in capital and retained earnings. And when we take them against assets, it would give us, sometimes referred as net assets or book value. So we're going to check those off. We've got common stock, paid-in capital, and retained earnings. And now we can finish our balance sheet. And here it is. We have our equity section. And if you notice, both balances are the same. And that completes this presentation on how to prepare a balance sheet. I hope that helps you with your homework.